name is Munaf. I'm a financial planner with Gradage Mahura Investments. I've been practicing as a financial planner for a little over 11 years now, and I specialize in investment and retirement planning. This is my second video that I'll be creating of a 6-part series on saving tax at retirement. If you haven't watched the first one, you can find it on our YouTube channel. In this video, I'd like to talk about how a retiree can reduce their tax liability by drawing their desired retirement income from two sources: compulsory sources and discretionary sources. What's the difference between compulsory funds and discretionary funds? Well, compulsory funds are your retirement funds. So retirement annuities, provident funds, pension funds, preservation funds, those are all compulsory funds. Discretionary funds is essentially everything else. So a money market account at the bank, a tax-free savings account, a unit trust plan, an endowment policy, those are all discretionary funds. Now, if you take compulsory funds and set up an annuity, which is what one would do at retirement, they'll take their compulsory funds or their retirement funds and they'll set up an annuity. It can be a life annuity or a living annuity. This is then referred to as a compulsory annuity. Compulsory annuities have their own tax rules, and discretionary funds have their own tax rules. It's the difference in these tax rules that brings about the opportunity for a retiree to save on tax within their retirement income plan. And it's this that I would like to discuss in this video. The first thing to clarify is the tax treatment of each. So with a compulsory annuity, it pays out an income, and that income that it pays out is fully taxable, and it's taxed as per the normal individual tax tables, where you'll get taxed as per the marginal tax rate that you're in. In terms of the capital, with the life annuity, there is no capital portion because you essentially purchase an income for life. But with the living annuity, there is a capital portion, and all the growth within the living annuities, all the interest growth and the capital growth that's generated is all tax-free. So with the living annuity, there's no tax on the growth of the capital. You only pay tax on the income that you draw, and that income is fully taxable. As per the individual tax tables. In terms of discretionary funds, because discretionary funds is considered after-tax monies, as in you've already paid the tax on that money and now it's after-tax and you now invest it. Because it's after-tax monies, the income that you draw is tax-free effectively because you're just drawing your own capital. So there's no tax on the income that you draw. There is tax, however, on the growth of the investment. So any interest growth or capital gains growth, there is tax on that. But it is important to remember that with discretionary funds, you do get the benefit of your annual interest exemption and your annual capital gains exemption. So I'm sure you can see now by looking at the tax rules of compulsory annuities and the tax rules of discretionary funds, how one can potentially reduce their tax liability by using this strategy. In terms of implementing this strategy, there are several factors to consider, but I wanted to illustrate the benefit of using this approach. So I've drawn up an example. It's a simplified example, but I hope it clarifies how this strategy can work. So in this example, we'll assume this scenario 1 and scenario 2. In scenario 1, it's an individual that only has 6 million rand in their retirement fund. They have no discretionary savings, so they cannot use this tax saving strategy. They put the full 6 million rand in a living annuity, which is a compulsory annuity, and their required income or their desired income is 40,000 rand a month. So they draw an income of 40,000 rand per month from their living annuity, and as you can see, the tax for that is 7,052 rand per month, and the total tax for the year would be 84,624 rand. In scenario 2, we have another individual and she has saved 3 million rand in a retirement fund and 3 million rand in discretionary savings. She implements a living annuity with her 3 million rand, and she has 3 million rand discretionary funds that she has access to. We can say it's invested into a unit trust, for example, and her desired income is also 40,000 rand. But instead of drawing 40,000 rand from the living annuity, she can draw 20 from the living annuity, 20 from the unit trust, from the discretionary savings. You can then see that the tax on that 20,000 rand from the living annuity is 1,003 or just under 1,400 rand, with the total tax for the year on the income from the living annuity amounting to 16,750 rand. In terms of the income from the unit trust, there is no tax on that income drawdown of 20,000 rand from the unit trust. There is, however, tax on the growth of the capital in the unit trust. For the sake of this example, we can assume that 1 million rand of the unit trust capital is invested into bonds, so it's income funds and it's generating interest, and 2 million rand is invested into equities. We can assume 8% as an interest growth rate and 10% growth rate from equities. So as you can see, 80,000 rand interest is generated off the 1 million rand invested into income portfolios, and 200,000 rand is the capital growth that's generated off the 2 million rand invested into equities. If we account for the annual exemptions that everyone is entitled to, then the total tax liability on the interest portion is 14,600, and in terms of capital gains tax, it's 16,600 rand. It is important to remember that capital gains tax is only payable when capital gains is triggered. And usually when setting up a plan that provides you a monthly income, we will not be triggering the full 200,000 rand of capital gain every year. So there would be a delay in incurring that tax liability and therefore additional compound growth within your investment. But for the sake of this example, and just to assess in terms of the tax due in both scenario 1 and scenario 2, we'll assume that the full capital gain has been triggered and we now have to pay tax for that full capital gain. So if we add all the tax liabilities from scenario 2, which is the tax on the income from the living annuity of 16,752, and then the tax on the interest earned in the unit trust and the capital gains in the unit trust, you can see that the total is 48,000 rand, which is the total tax in scenario 2. Compare that to the tax due in scenario 1, where you also had 6 million rand, but that 6 million rand all went into a compulsory annuity. The tax was 84,600 rand, so approximately 36,000 rand more in tax in scenario 1. To get the max value from this approach, there are a few things to consider. The first one would be to determine the correct or the most tax efficient proportions of income. So how much income do you draw from the compulsory annuity? How much do you draw from the discretionary savings? But at the same time, to ensure that you're not depleting either of the capital amounts too quickly. So you want to determine the appropriate income amount, or the most tax efficient income amount, but also to ensure that that income is sustainable right through to your life expectancy. Then it's also important to ensure that the portfolio, the asset allocation for the compulsory annuity and the discretionary savings is appropriate for the retirement income plan. And then also to ensure that you're taking advantage of your annual interest exemptions and your annual capital gains exemptions each year. And if you have a tax-free savings account with a significant investment value in it, then definitely worthwhile to incorporate that into the retirement income plan, because we now have an investment that is fully tax-free, so we would want to get the most value out of that. All right, that was my second tip on saving tax at retirement. If you do have any questions, need any clarity, feel free to reach out. I'll share my next tip within the next 2 weeks. Till then, keep well. Goodbye.